Between 2011 and 2020, one bank quietly accumulated more silver than most countries hold in their reserves. Not millions of ounces, not hundreds of millions, 1 billion ounces. At today's prices, that's roughly $30 billion worth of physical metal, sitting in vaults, registered under their name, verified by independent auditors. J.P. Morgan Chase, the largest bank in America, built the single largest private stockpile of silver in modern history, while simultaneously being investigated, fined, and convicted for manipulating the silver market. They got caught rigging the game, paid the penalties, and kept playing. Except now, they're not shorting silver, they're holding it, which means one of two things is true. Either this is the most patient, calculated trade in financial history, positioned to profit from a crisis they saw coming a decade ago, or it's something else entirely, something that only makes sense if you understand what silver actually is, who controls it, and why J.P. Morgan stopped fighting the market and started owning it.
Let's establish the timeline, because the details matter. In 2010, silver was trading around $18 an ounce. It had been rising steadily since the financial crisis, driven by investors looking for safe havens and industrial demand from Asia. J.P. Morgan had massive short positions in silver futures. They were betting the price would fall. That's normal for banks. They hedge, they speculate, they manage risk. But in 2010, a London metals trader named Andrew Maguire went public with allegations that J.P. Morgan wasn't just betting on silver, they were controlling it. He claimed the bank was actively suppressing the price by flooding the COMEX with short contracts during key trading hours, triggering stop losses and forcing the market down. Then they'd cover their shorts at lower prices and repeat. Naked shorting, spoofing, market manipulation. Maguire provided dates, times, and price movements to regulators before they happened, and they happened exactly as he predicted. Nothing was done for years. Then, in 2020, the Department of Justice charged J.P. Morgan with manipulating precious metals markets. The bank admitted guilt. They paid nearly $1 billion in fines, one of the largest market manipulation cases in history, proven, settled. But here's the strange part. While they were being investigated for shorting silver, they were also accumulating it physically in staggering quantities. The very metal they were accused of suppressing, they were buying by the truckload and storing in their own vaults. Why?
To understand what J.P. Morgan did, you need to understand how silver moves. Most silver isn't owned by investors. It's produced by miners, refined into bars, and sold to industrial users or mints. Along the way, it can be stored in COMEX warehouses, where it sits as inventory backing futures contracts. There are two categories of inventory in COMEX vaults: registered and eligible. Registered silver is available for delivery against futures contracts. It's actively part of the market. Eligible silver is stored there, but not available for delivery unless the owner decides to register it. J.P. Morgan operates the largest COMEX silver vault in the world. They store metal for themselves and for clients. And starting in 2011, something unusual began happening. Silver started piling up in J.P. Morgan's vault. At first, it was normal inventory fluctuations, but it didn't stop. Every month, more silver came in than went out. By 2015, they held over 50 million ounces. By 2017, it was 300 million. By 2020, independent analysts estimated they had crossed 1 billion ounces. Not all of it registered, not all of it even reported to the COMEX. Some of it held ineligible, some offshore, some in private storage, but the total kept climbing. Now, J.P. Morgan has never confirmed the exact number. They don't have to. Vault data is reported in aggregate, not by owner. But researchers like Ted Butler and Steve St. Angelo tracked the flows for years, matching import data, mint production, and vault inventories. The pattern was undeniable. While JP Morgan was paying fines for suppressing silver prices, they were hoarding physical silver at those suppressed prices. They rigged the market, got fined for rigging it, and used the rigged prices to buy the asset they were rigging. Let's talk numbers, because this is where it gets absurd. Global silver mine production is about 800 million ounces per year. Demand from industry, jewelry, and investment is slightly higher. That deficit gets filled by recycling and above-ground stocks. 1 billion ounces represents more than 1 full year of global mine production. It's roughly 10% of all the investment-grade silver bullion that exists in the world. One institution, 10% of available supply. If JP Morgan bought most of that silver between 2011 and 2020, they were accumulating during the lowest sustained price period in modern history. Silver spent most of that decade between $14 and $20 per ounce. Let's assume an average cost basis of $17. That's $17 billion in acquisition costs, plus storage, insurance, and logistics. For a bank like JP Morgan, that's manageable. They generate $40 billion in annual profit. They can move that kind of capital without blinking. But here's the question: why? Silver doesn't pay dividends. It doesn't generate yield. It just sits there, costing money to store, while tying up billions in capital that could be deployed elsewhere, unless they know something. Unless they looked at the same supply and demand data everyone else sees and concluded that the price of silver 10 years from now will be so much higher that even a $1 billion fine and a decade of storage costs will look like a rounding error. Or unless the goal was never profit at all. There are two versions of this story circulating, and they can't both be true. Version 1. JP Morgan is making the trade of the century. They saw the coming electrification of everything: EVs, solar, 5G, grid infrastructure. All of it runs on silver. Demand was going to explode. Supply was stuck. So they used their position as a dominant futures trader to suppress prices while secretly accumulating physical metal. When demand finally overwhelms supply, they'll own a massive percentage of the market and sell at multiples of what they paid. It's ruthless. It's possibly illegal, but it's brilliant. Version 2. JP Morgan is acting as a proxy, not for profit, for control. Silver is strategic. It's not just money or jewelry. It's a critical industrial input for weapons systems, electronics, medical equipment, and energy infrastructure. Countries that control silver have leverage. Countries that don't are vulnerable. In this version, JP Morgan isn't hoarding silver for themselves. They're hoarding it for the United States government or for a coalition of central banks to ensure that when shortages hit, America has supply and China doesn't. The bank takes the reputational hit, the government gets the metal, and if prices spike, the profits get funneled into the treasury through some quiet arrangement no one will ever see. Both versions are plausible. Neither can be proven. What we know is this: JP Morgan is the only major bank with a physical silver position of this scale. Goldman doesn't have it. Morgan Stanley doesn't. Citi doesn't. Just JP Morgan. And they started building it right after the 2008 financial crisis, when trust in fiat currency was at a generational low, and central banks were printing trillions. Coincidence? Maybe. Or maybe they understood something about the next 20 years that the rest of the market missed. Now here's where this gets dangerous. If JP Morgan holds 1 billion ounces of silver and a supply crisis actually materializes, they don't just profit, they control the market. Imagine a scenario where industrial demand spikes, solar installations double, EV production ramps up faster than expected. Suddenly, manufacturers need more silver than the market can provide. Who do they call? The miners are already selling everything they produce. Recyclers can't scale fast enough. The COMEX has limited registered inventory, but JP Morgan has 1 billion ounces sitting in vaults. They become the only source of supply, and they can name their price. $50 an ounce? 100? More? At that point, it's not a free market anymore. It's a monopoly. And monopolies on critical industrial materials are exactly the kind of thing that attract government intervention. In 1933, the U.S. government confiscated private gold holdings through Executive Order 6102. Citizens were required to sell their gold to the Treasury at a fixed price. Could the same thing happen to silver if one bank controls too much of it during a national emergency? Legally, yes. Politically, maybe. But if JP Morgan is holding that metal on behalf of the government, confiscation becomes unnecessary. The metal is already where the government wants it. This is the quiet part no one talks about. Let's zoom out. Silver is the only metal that's both a monetary asset and a critical industrial input. Gold is money, copper is industry, silver is both. And that makes it uniquely dangerous in a world where currency wars and supply chain wars are merging. China controls rare earth elements. Russia controls palladium. The US controls very little. But if the US, through JP Morgan, controls a significant percentage of available silver, that changes the calculus. It's a hedge against de-dollarization. It's leverage in trade negotiations. It's insurance against a scenario where digital currencies replace cash, but people still want something physical to hold. JP Morgan didn't accumulate 1 billion ounces by accident. This wasn't a rogue trader or an opportunistic bet. It was systematic, decade-long, executed while under investigation. That level of commitment only makes sense if the end game is bigger than profit, and the end game might not even be JP Morgan's. So here's what we're left with. The largest bank in America spent a decade accumulating more silver than most nations possess. They did it while being fined for manipulating the same market. They've never explained why. They've never disclosed the full position, and they continue to hold it. If this is just a trade, it's the most patient, most expensive, and most secret trade in modern finance. If it's something else, a strategic reserve, a government partnership, a move in a larger geopolitical game, then we're watching a shift in how resources get controlled in the 21st century. Either way, one thing is certain: JP Morgan knows something the market doesn't, or they're betting on something the market won't believe until it's too late. And when a bank that got convicted of rigging silver suddenly becomes the largest holder of silver, you don't dismiss it as a coincidence. You ask the question no one wants to answer. What are they preparing for?